What if the next UK housing crash doesn't start in London? Or even in Britain? What if it begins thousands of miles away, with one signature, one tariff, and one political decision in the United States? Donald Trump's tariff war is back, and while most people think it's just about trade, the real damage is about to hit something far closer to home: UK property prices. Because when global trade breaks, mortgages tighten, jobs vanish, and housing markets don't fall slowly, they crack suddenly. Tonight, we expose how a trade war America started could put British homeowners, landlords, and first-time buyers directly in the firing line. As Trump once again threatens sweeping tariffs on imports, markets are already reacting. Investors, lenders, and developers understand something the public rarely sees in real time. Trade wars are not fought only at ports and borders. They are fought in balance sheets, credit markets, employment figures, and ultimately in house prices. The UK may not be the primary target of Trump's tariffs, but it does not need to be. Global trade is a tightly wound system. When one major economy pulls hard on the thread, the entire structure begins to strain. Higher tariffs raise costs for manufacturers, slow global growth, and push inflation higher. Central banks respond, borrowing costs rise, and suddenly the affordability equation that props up property markets begins to collapse. The first pressure point is inflation. Tariffs are, in effect, a tax on goods. When the cost of imported materials rises, businesses pass those costs down the chain. Construction becomes more expensive almost immediately. Steel, timber, glass, electrical components, all of them are exposed to global supply chains. For UK developers already squeezed by labor shortages and planning delays, even a small rise in material costs can be the difference between profit and cancellation. Projects stall. New housing supply tightens. On the surface, this sounds supportive for prices, but that is only the first act. The second pressure point is interest rates. Trade wars historically push inflation higher while simultaneously slowing growth, a toxic combination. Central banks are forced into a corner. If inflation rises, rates must stay higher for longer, even as economies weaken. For the UK housing market, which is deeply dependent on cheap credit, this is devastating. Mortgage rates do not need to spike dramatically to cause damage. Even a small, sustained increase can remove millions of buyers from the market. Homeowners coming off fixed-rate deals face brutal resets. Buy-to-let investors, already under pressure from tax changes and regulation, see margins evaporate. Forced sales begin quietly at first, then the listings rise. Sentiment turns, and property, a market built on confidence as much as fundamentals, starts to slide. The third pressure point is employment. Trade wars reduce global demand, exporters suffer, multinational companies cut costs. Investment decisions are delayed or canceled entirely. The UK's economy is heavily exposed to global finance, manufacturing supply chains, and services linked to international trade. Job insecurity spreads faster than official statistics can capture. And when people fear for their income, they do not buy houses. They retreat, they save, they wait. This is where property downturns are born. Not in headlines, but in hesitation. London, often seen as untouchable, is especially vulnerable. Its property prices are built on global capital flows. International buyers, foreign students, overseas investors, and corporate relocations all play a role. A global trade war disrupts capital movement. Currencies swing wildly. Risk appetite collapses. High-end property, which depends on confidence and liquidity, can turn from an asset into a liability almost overnight. Regional markets are not spared either. Areas dependent on manufacturing, logistics, or export-linked industries feel the pain first. Falling local employment feeds directly into falling local prices. History shows that once regional cracks appear, national averages follow. There is also the issue of government finances. Trade slowdowns reduce tax receipts. At the same time, pressure grows for public spending to support struggling households and businesses. This limits the government's ability to stimulate the housing market. Schemes like Help to Buy are politically unpopular and financially costly. With stretched budgets, there is little room for rescue. Banks, watching all of this unfold, become cautious. Lending criteria tighten quietly. Loan-to-income ratios shrink. Stress tests become harsher. The availability of credit dries up just as demand weakens. This credit contraction accelerates. Price declines far more than most people expect. What makes Trump's tariff war particularly dangerous is its unpredictability. Markets can price in bad news. They cannot price in chaos. Sudden tariff announcements, retaliatory measures, and diplomatic breakdowns create volatility that freezes decision-making. Developers pause. Buyers hesitate. Sellers rush for exits. Volatility, not fundamentals, becomes the dominant force. The UK property market has already been weakened by years of strain. Real wages have not kept pace with house prices. Household debt is high. Affordability is stretched to breaking point. This is not a market positioned to absorb another global shock. It is a market balanced on confidence, and confidence is fragile. Some will argue that property always recovers. That may be true over decades, but markets do not move in decades. They move in cycles, and cycles punish those who enter at the wrong time, over-leveraged and underprepared. A trade war does not need to cause a crash to inflict serious damage. A prolonged stagnation combined with falling real prices and rising costs can be just as destructive to household wealth. For investors, this moment demands caution, not optimism. Yield assumptions must be stress tested. Vacancy risk must be taken seriously. Leverage should be reduced, not expanded. For homeowners, the priority is resilience. Fixing mortgage rates where possible, building cash buffers, and resisting overextension are not signs of fear. They are signs of prudence. For policymakers, the warning is clear. The UK cannot treat housing as separate from the global economy. Trade policy, inflation, employment, and property are inseparably linked. Ignoring that reality only increases the eventual cost. Trump's tariff war is not just a political tactic, it is an economic shockwave. And like all shockwaves, it travels far beyond its point of origin. The UK property market is directly in its path. This is not a prediction of doom, it is a reminder of risk. Markets do not collapse because of one event. They weaken through a chain reaction of pressures that build quietly, then move suddenly. The signs are already visible for those willing to look. In an interconnected world, no property market stands alone. And as trade wars return to the global agenda, the question is no longer whether UK house prices are affected, but how prepared homeowners, investors, and policymakers are for what comes next.